Welcome to this March edition of Amundi's Market Review. Markets are focusing their attention on central banks and how much longer these intend to keep rising interest rates to cool inflation. This, coupled with concerns on corporate earnings and escalating geopolitical tensions between the United States and China, has soured market sentiment. Consequently, equities in the United States, China, Hong Kong, and the broader emerging markets declined. However, in Europe, the mood was lifted by lower energy prices and its effect of alleviating the cost of living crisis. Looking ahead, we think markets should come to realize that the job of central banks with respect to inflation is not yet done, and that the risks of a corporate earnings recession remain. We see a contrast between financial markets and the real economy, with lending conditions for consumers and corporates starting to tighten. This does not bode well for consumption and exposes the economy to further slowdown. As a result, we downgraded our US growth expectations for the end of the year due to investment weakness and slowing private consumption. In the Eurozone, although we upgraded our annual 2023 forecasts, we think major headwinds to growth remain. China's reopening is certainly a positive for its own economy, but will not be sufficient to markedly affect other major economies. In this environment, inflation has peaked, but still remains sticky, and thus the risk is that the central banks will be forced to stay hawkish for longer. For the time being, we foresee a first rate cut in January next year, but a lot would depend on the inflation and growth pattern. For the European Central Bank, however, it looks very unlikely that it will cut rates soon. Recent corporate earnings results seem to confirm a slowdown. In the United States, market expectations for 2023 operating earnings looks implausible, given concerns on consumption. In Europe, an expected slowdown in earnings is confirmed, but in an overall fragile environment, European equities remain a wild card in global portfolios. While we acknowledge the upward market movements seen this year, we do not think a sustained upside led by fundamentals is likely in the near future. Instead, investors should focus on the following convictions: slowing rate hikes in the developed world and the potential weakening of the US dollar are painting an attractive picture for emerging market assets. We are slightly more positive on emerging market debt, for instance in Latin America, but realize the need to be selective owing to high country-specific risks. On equities, the continued economic reopening in China keeps us constructive there. On the other hand, in developed markets where the view is cautious, we think there is a need to stick to businesses with a good earnings potential, attractive valuations, and appealing dividends. A gradual approach into equity markets is recommended after the 2023 rally. Corporate credit yields are attractive for fixed income portfolios, but investors should prioritize high-quality segments such as investment grade, issued by companies with strong balance sheets. Finally, we believe investors should continue to focus on diversified multi-asset solutions. For example, they may benefit from opportunities offered by commodities such as oil and precious metals like gold. To sum up, investors should remain well diversified amid an uncertain global macroeconomic picture. In addition, they should aim to benefit from regional divergences, for instance in China, avoid markets with excessively high valuations, and remain patient for later opportunities and future entry points. Thank you for listening and see you next month.